coronavirus is causing panic and the markets are seeing red as we witness record-setting sell-offs. But in this video, I'm going to break down the difference of facts versus opinions, but more importantly, I'm going to talk about what we as investors should be watching for and what we should be doing right now. So stay tuned. All right, welcome back. If you are new to the channel, my name is Mark Moss. I like to talk about making money, investing money, and just overall, general success. Now, if you like those types of topics, which I'm sure you do, make sure to click like and subscribe right now. Make sure you hit that bell notification so you don't miss any new videos that I come out with, especially urgent and breaking news ones like we're doing today. So today we are going to be talking about being prepared, right? Now, I've done several of these videos kind of recently because we've been seeing opportunities to test our investments, to test our portfolios. So recently we've seen a few different shocks to the market, and so I've dropped videos about that, and I said it's always a good reminder to look at our investments, look at our portfolios. Did they hold up? Recently there was the whole deal with Iran where we're going to go to war with them, and I made a video about that, and I said, how did your portfolio hold up with that? Are you ready for this? There's black swan events that could happen at any given time. And that's what we're seeing right now. That's what the coronavirus is, the Wuhan flu, whatever you want to call it. But it's what we call a black swan event. It wasn't something that we saw coming. It just came out of nowhere, and it's causing massive havoc. It's wreaking havoc. And so it's obviously, everybody's really worried about it. It's creating panic, and the markets are crashing. I believe yesterday the markets crashed like 1,200 points. It was the largest crash, single-day crash in history out of like 127 years. So really, really bad. People are panicking. People are getting sick. People are dying. The whole country of China is supposedly shut down, etc. Right? So we're seeing lots of panic and all that. So that's what's going on. And I want us to look at the facts versus the opinions here. All right. So first of all, the facts are as of today, when I looked this morning, there's about 82,000, 83,000 reported, I say reported people that have been affected. There's been under 3,000 dead. It was about 2,800 this morning, about 3,000 dead. So that's the facts. All right. Now, those numbers are open for interpretation. Are the Chinese underreporting it, etc.? We'll talk about that. But those are the facts. 82,000 infected, about 2,800 dead. And if we compare that to the flu, then we need, we'll get a different perspective. So compared to the flu in the United States in 2018, I believe it was, we had over 80,000 people die. Not infected, 80,000 people die just in the US alone from the flu. So even if China was underreporting the numbers, even if the numbers were 10 times what they've reported, so there's 27,000, it's still only a fraction of the people that have died from the flu just in 1 year and just in the United States, okay? Those are the facts. Now, the opinions. The opinions are people saying, well, it could be way bigger than we think. It could be. We don't know, right? People are saying it's more deadly. Well, maybe, maybe not. It depends on what numbers you look at. It's based off of reported people that are infected, and a lot of people that are affected aren't being reported. And so actually the number of infected is probably way higher, which actually makes it the death toll lower. Some people think that it's less deadly than the normal flu. So we don't really know at this point. But what we do know is I believe as of yesterday, nobody under the age of 60 had died. So just like the normal flu, it really affects people that are elderly, people that are already sick, etc. And so those are opinions. So what I would say is that, if you're personally worried about it for your own health, work on staying healthy, right? It affects people that are old and sick. So you can't help being old, but don't be sick, right? Get to exercise, get good sleep, eat proper, etc., right? I'm not going to go into all those health things. Although I am super big into health. If you want me to go into the health things, leave me a comment down below and we'll talk about that. But for right now, we're going to talk about our money. So the markets are selling off. And one of the reasons why the markets sell off so fast, and this is an important piece to understand, is that markets are what they call a discounting mechanism. All right, so people buy stocks, people buy assets because they believe they're going to go up in the future. So I'm buying it today, hopefully buying low, selling high. So I'm buying it today, hoping it's going to be worth more in the future. But it also works the other way. So right now, investors are afraid that the assets will be worth less in the future, so they're trying to get out now. And the reason why that's happening is because pretty much all of China is kind of shut down. And back to a little bit of opinion. So for me, personally, the way I'm looking at it is I think it's too early to panic because of the amount of people that have died versus being sick. However, because China has shut down, it does obviously make it seem much more dangerous. And why are they overreacting? And there's a whole nother conversation that we can get into as far as that's concerned. But what it's done is that it's created this supply chain shock because China is like one of the largest producers in the world of all types of goods, and not just producers, but also consumers. And so, for example, all the factories are shut down, so they're not selling products. So, all the drop shippers, they're not getting their products. Apple iPhones aren't coming off the line. In addition, the consumption is going down. So the Starbucks in China, for example, they're not bringing in revenue. McDonald's in China, not bringing in revenue, etc. And so we're seeing the supply chain shock, which is affecting the whole world. And the revenue numbers. Now, it used to be that, whatever happened in China, and so the Chinese economy could crash. But today, because of globalization, the whole world is being affected by this. That's a whole nother topic for another video. Leave me a comment if you want to know more about that. But what's happening is because of this supply chain shock, because companies aren't shipping products, because companies aren't doing business in China, they're going to start missing their forecasts. And so as the first quarter reports come out, well, they're already starting to downgrade how much money they're going to make. And as revenues and profits go down, earnings go down, stocks go down. And so everybody's getting out in front of that. It's a discounting mechanism. They want to get out before all those numbers, before all those missed forecasts happen. Now, what's the short-term view? We're going to look at the long-term view, and then, like I said, I'm going to tell you exactly what you need to be doing about this. So the short-term view is that markets are dropping. We look at history, we can see there's been 14 different pandemics that we've studied, that I've charted, and each one has seen short-term pain in the market, meaning the market crash. And each time we typically see within 3 months and even up to 6 months a double-digit return, a bounce back. So will this one be the same? We don't really know. But what it seems like right now is everybody's waiting on the Fed and the central banks to intervene, meaning pump massive money, pump massive liquidity in the markets. China, the PBOC, the Bank of China, has already been injecting a lot of money into the economy. Everybody's waiting for the Fed to lower rates, ease rates, put money back into the market, etc. Now, if they don't do something soon, then the markets could really plunge. And so right now we're kind of waiting to see what happens. If they do move really fast and turn those bazookas on like President Trump is urging them and like everybody else is kind of expecting, then we might see this massive recovery, like this V bottom where all of a sudden stocks have been falling, and then they bounce up. Now, historically, a 10-15% drop is pretty drastic, and so we're about right there right now, and so maybe the markets could settle right here. Typically, when they fall this fast, this hard, we'll see at least what's known as a dead cat bounce, which means they'll at least bounce up before they'll continue down. So those are a couple things that we're watching for. And again, we're watching the signs. We don't know. I'm not trying to predict what's going to happen. I do believe the Fed and the central banks are going to intervene. That's my opinion. But will they intervene fast enough and hard enough, or are they going to wait too long? Typically, they will intervene, but wait too long, and so we're waiting to see. So what are the long-term views, though? So this is short-term. What's the long-term views? Well, the long-term views are we have massive tailwind that are blowing to keep this market intact, to keep the numbers going up, to keep all these markets continuing to climb. So I'm going to give you three. All right, so I'll give you three different tailwinds that I'm looking at. So number one is the central banks. Now, I already hinted to the central banks. The central banks are printing money, pumping liquidity into the system. Since 2008, they've injected over $11 trillion. Yeah. $11 trillion. That's a lot. $11 trillion they've pumped into the market. They've been fighting deflation for over a decade. They've been trying to keep these markets up, trying to keep them from going down. And so I don't see them stopping right now. They're not going to be like, oh, well, it was a good fight. For 10 years, we tried really hard and now we're going to walk away. I don't see that happening. I see them continuing to print even harder, print faster, lowering rates, pumping liquidity in. I can already hear the comments. They don't actually print money. I get it, but it's a terminology. You know what I mean? So I don't see them stopping that fight since 2008. They're going to continue to prop these markets up, and that's going to be a continued massive tailwind. We know all the central banks around the world are printing massive amounts of money, lowering values. Interest rates are going negative, and that's a trend that's going to continue. And it's going to continue until it can't continue any longer. So that's number one. Number two is a big one. Number two is demographic change. And there's something called the golden ratio. And basically it's when a group of people, or the number of people, the population that from 35 to 49 grows larger than that of the people from 20 to 34. So what happens during this golden ratio is that GDP, gross domestic product, it grows faster. And because of that, corporations make more profits. The stock market rises faster, right? All those things. Those are all good things. And the Census Bureau, they project that the median age of Americans is going to rise significantly between 2020 and 2050. So like over the next 30 years, we're going to continue to see this golden ratio push demographic growth. So we have the Fed pumping in money, we have demographic change, this golden ratio, and then number three is a big one too, is technology. And so we're seeing massive innovation happening right now. And what that innovation is doing is it's increasing profits and it's lowering costs at the same time. It's exploding productivity. So a recent government study found that American workers' productivity increased by 1.7% in 2019, last year. That's massive. That's a massive increase in productivity. And we're seeing this technology mainly like in blockchain technology, which I talk a lot about, robotics, artificial intelligence, energy creation, energy storage, renewable energy, and autonomy, automatic, self-driving cars, etc. And so we're going to continue to see massive technology, massive innovation, massive productivity gains, which is increased profits and lower costs. So you take those three together and the future looks pretty bright. What's going to happen in the short term? How long will coronavirus stick around? Is the world going to end? I don't think so. So how are we going to play this? What are we going to do? All right. So first thing first, don't panic. All right. My sister's an emergency room doctor. They get a patient in and they have to assess the situation before they do anything, right? Navy SEALs have a saying that says, relax, look around, and then make a call. So that's what we need to do. We need to relax, look around, and make a call. That's why I went over the facts. We went over the opinions. Now, will the Fed interact? I don't know. Will the market stabilize? I don't know. So we're looking at all these things that there's some crucial points here. If the Fed, like I said, if the Fed doesn't interact, if the markets don't make a bounce here within the next couple of days, within the next week, well, that's not going to be good. And then we're going to have to act one way. If they do intervene, if the markets do bounce within the next couple of days, well, then that tells us something different. So right now, we're watching, we're waiting, all right? Now, what are the actions that you should take? All right, well, one, assess the situation, pay attention, watch, right, of course. But what we always want to do, and in the couple videos leading up to this, I talked about testing your portfolio with these recent scares that we had seen. Was your portfolio set up to handle that? And if it wasn't, then you need to adjust. So how do you do that? You do that by taking diversified allocation. So you don't put all your money in one basket, right? You don't have all your money in stocks. If you had all your money in stocks, especially into some of these main core sectors, you saw a massive drawdown in your portfolio, and that was super painful. Hopefully that didn't happen to you. And so you want to have your money allocated into different things. So for example, just super simple, let's say that I had 50% of my portfolio in stocks and 50% in cash. Well, even if that 50% dropped by 20%, which is painful, it actually only brought my total portfolio down by 10 because I've diversified my risk. Now, we can continue to break that down on and on and on, but you get the point. And so what you want to do is you want to have your money, your investments, your portfolio into different types of allocations, especially that can move differently. So for example, gold has been doing really good. Gold is on a tear. And so if you've been holding gold, you've seen your portfolio going up and you've seen your stock going down, and maybe they've evened each other out. Maybe you've actually made money even though stocks were crashing, depending on how you have your allocation set up. The thing is that you need to figure out what your own thesis is. What is your own specific situation? So for example, if you have 20 years to invest before you have to worry about retiring, then you definitely want to stay in the market. You can afford to be a little bit more aggressive, because what happens is we can't time the market. We don't know when that V bottom bounce is going to occur. And studies have been shown that if you sat out like the best 10 days out of 20 years, only 10 days out of 20 years, you could have your returns cut in half, sometimes not even make returns, because the best days in the market typically come after the worst, and that's when people are sitting out of them. So you want to stay in the market, and if you have a long enough time frame, then you're going to be able to make your money back. Like I said, we have those 3 massive tailwinds. However, if you're a very conservative investor, you have a shorter time period before you have to retire or you need your money, then you need to change. You need to move your portfolio to a more conservative, move it more towards cash flow, more towards cash hedge, gold, etc. So that's how you want to do that. And then, of course, regardless of where you find yourself, risky, conservative, etc., mind your stop losses, right? We need to use stop losses. We put those in there for a reason that limits our exposure, it limits our risk, it limits our losses, right? And so make sure that you're minding those stop losses. So hopefully all that makes sense. Leave me a comment down below. Let me know what you think about the tailwinds. Let me know, are you going to stay in the market and ride this out? And hopefully you have your portfolio set up. I'm going to be doing some training about that. So check in the description. You can find more about that. And that's it. Hopefully that makes sense. Happy investing to your success. I'm out.